Hi, this is Pat with Energy Solution Partners sharing with you our energy market view on Monday, April 11th. Keep in mind there is a risk of loss when trading commodity futures and options. It's been a while since we've shared some of our market views, and we'll try to get on track and do this a little more frequently again. But we are at an interesting point, I think, in this energy cycle here. And it appears the oil market is in the process of rebalancing, which has been a long awaited process. It's often been said that the cure for low prices is low prices. It is interesting to note that since 2014 downturn, 27 billion barrels worth of oil projects have been canceled. This is $380 billion in capital expenditures that energy companies have announced cuts on that will not take place. So just a huge, huge amount. And it does take time for this to work through the whole system, as these are large multi-year projects that are planned years in advance. So the reality of these cuts are probably yet to be seen here as we move into future years. But interesting to note that the natural depletion of existing oil fields is about 5 million barrels per day per year. So every year we need to replace 5 million barrels per day of production just to replace what we are depleting. And then there's typically an annual demand growth of 1.2 million barrels per day. So each year we need to see annual supply additions of 6.2 million barrels per day just to take care of what we've already got. And that's where these capital expenditures are so necessary to keep up with the natural depletion rates. Um, and along with meeting new demand. So again, I think a lot of this is yet to be seen in future years here as this market does continue to rebalance after the price collapse. It is also interesting to watch how our production has followed the drill rig counts. But this gold line being the drill rigs operating in the U.S., and you can see how this really ramped up in 2010 as we started tapping some of the shale formations and finding the new oil source here in the U.S. But the actual production didn't start to show until nearly 2 years after the new drilling had started. So there's a natural lag in place as these capital expenditures took place, and we'll see the same type of lag on the way down. Um, Drill rigs peaked out nearly 1,600 units drilling in the U.S. here back in June of 2014. Today we're down to 350 rigs operating, so just a substantial drop off as these capital expenditures have dropped. Um, and now watching what production is done in that time, again we're seeing the lag. We peaked out production in summer of 2015 at about 9,600 barrels per day. And that is second only to Saudi Arabia. So just a huge response in oil production here in the U.S. We have seen that production start to tail off ever so slowly, but today we're operating just barely above 9,000 barrels per day of production, and we'll probably see that drop below 9,000 here in the next few weeks. And it's probably going to be a media event when this does happen and catch more attention as the production is starting to drop and respond to these reductions in capital expenditures. Looking at our monthly crude oil chart, everybody knows what the prices have done, but I'm focused again. This is more of a technical setup and the stochastics measurements. And we've been sitting down here in the oversold position for about a year and a half since the price collapse did happen. But now, over the past couple weeks, we've started to see a little reaction to the upside here and getting some momentum. And so I think the market is always looking ahead, probably looking at some of these production numbers and what the expectations are. I think there's some pretty great expectations to see these production numbers drop as we continue to move forward. And those figures are just U.S. numbers, but we're seeing the same type of scenario happen all over the world. So as the U.S. has already taken um, 600,000 barrels per day off production line, again, we're just one country in the whole production source. So you've got multiple countries seeing the same type of scenario, and we take a couple million barrels of crude oil production offline here, and that's substantial. Another item I like to look at is the carry in the market. And what this chart depicts is the crude oil futures month 12 months out compared to the current month of trade. Um, and as we watch this carry into these big numbers like we were back in February, nearly $12 a barrel carry in the market, meaning 12 months out was trading at $12 a barrel higher than the current month. And what this tells you is the market does not want the crude today. It's paying you to store that, given a financial incentive to store that oil. But look what's happened since then. This cost to carry has dropped substantially, and we're now under $5, approaching $4 a barrel, which is telling you this market is becoming more balanced. The incentive is not there to store these barrels anymore. We're working through some of the supply glut, so the incentive again to store these barrels is not there, and it's paying you a little more on the front month to provide those barrels to market than what it had been. So this is a sign that the market is shifting. Again, probably looking forward into these expected production numbers. That's kind of a macro view, long-term picture of what we see going on in the marketplace here. I do think as we come into 2017, this market's going to look a lot different than it does today. Um, Not afraid of looking out into next year to start taking some positions. End users, probably a real good time to start hedging some of those purchases. If you can find the interest out there. Any marketers that are looking to put some programs together, definitely feel free to contact us and we'll see what we can put together. Thank you and have a great day.